Hello and welcome to the Money and Banking Law Podcast with Joe Sylvia, brought to you by the global law firm of Duane Morris. I'm your host, Joe Sylvia. I'm a former Federal Reserve lawyer who represents banks, fintechs, and other clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. The goal of the Money and Banking Law Podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. On this episode, we are talking about the newly issued OCC Interpretive Letter number 1188. So the subject of Interpretive Letter 1188 is national bank engagement in riskless principal transactions in crypto assets. So naturally, as it just came out a few days ago, and as I'm part of our digital assets and blockchain practices, I figured that this was something that warranted a discussion on the podcast. So the interpretive letter is a really nice outline of what these riskless principal transactions are and how it applies to crypto assets. And ultimately, what this letter is indicating in response to a request for confirmation from someone was that national banks can engage in riskless principal crypto asset transactions, which are described in the letter, with and on behalf of their customers. So I guess in certain applications that the OCC has received recently, either for de novo bank charters or otherwise, they've had applicants that have specifically stated an intention to engage in these kinds of transactions related to crypto assets. So as the OCC letter indicates, in a riskless principal transaction, an intermediary, here a bank, purchases an asset from one counterparty for the immediate resale to a second counterparty, which is the ultimate purchaser of the asset. So the bank's purchase of the asset is conditioned on some offsetting order from that ultimate purchaser of the asset, so that the bank doesn't actually hold the asset in its inventory, except in extremely rare circumstances where you have some kind of settlement default or otherwise. So the bank in these riskless principal transactions essentially conducts itself as a legal and economic equivalent of a broker acting as agent, as it's outlined in the OCC letter. These transactions are thought of as riskless because the bank doesn't enter into the initial purchase transaction without having also entered into the immediately offsetting transaction on the back end. However, this is not to say that there is absolutely no risk with these transactions. For crypto asset securities transactions, 1188 quickly outlines and articulates the permissibility of riskless principal securities transactions under 12 U.S.C. 24/7. And that statute says, the business of dealing in securities and stock by a bank is limited to purchasing and selling the securities and stock without recourse, solely upon the order and for the account of customers, and in no case for its own account, and the bank shall not underwrite any issue of securities or stock. And so the outline of traditional riskless principal securities transactions, as reviewed by the OCC, is no different just because you have a crypto asset that is a security. And so the analysis is the same and quickly becomes clearly permissible for a national bank to engage in a riskless principal crypto asset securities transaction. So that's a very quick piece of the analysis in this interpretive letter. The meat of the analysis really is on riskless principal transactions in crypto assets that are not securities. But again, we look at 12 U.S.C. 24/7, and that provision also provides authority for national banks to exercise, quote, all such incidental powers as shall be necessary to carry on the business of banking. However, the business of banking isn't defined in the statute. Where we see factors that the OCC considers to be, quote unquote, identifying as the business of banking is in 12 CFR, so the Code of Federal Regulations, at section 7.1000 C1. And so the letter provides the citation, and it outlines the couple of factors that the OCC considers when determining whether an activity is actually part of the quote unquote business of banking. So first, whether the activity is the functional equivalent to or a logical outgrowth of a recognized banking activity. Second, whether the activity strengthens the bank by benefiting its customers or its business. Third, whether the activity involves risks similar in nature to those already assumed by banks. And fourth, whether the activity is authorized for state chartered banks. On these types of riskless principal transactions in crypto assets that are not securities, the OCC confirms quickly that the first three factors are essentially satisfied. They weigh quote unquote, weigh strongly in favor of determining that the transactions are part of the business of banking. For the first factor, it indicates that, look, these types of transactions are both the functional equivalent to recognized bank brokerage activities, and they're also a logical outgrowth of crypto asset custody activities. Again, custody activities already approved. Specifically, as part of the traditional role of banks as financial intermediaries, these institutions already have broad powers under the statutes and regulations to buy and sell financial and investment instruments as agent for the customers. This is a quote that's in the interpretive letter, and it's a quote from a much earlier interpretive letter from 1990, interpretive letter number 499. An example that they provide is that they say national banks broker a wide variety of financial instruments and asset classes, including futures, options, and other derivatives. And courts have acknowledged that national banks have the ability as agent to acquire a wide range of other assets for customers, including obtaining railroad, steamship, or airline tickets for customers, or providing information helpful to customers in connection with their travels. And the reference there for any of the banking nerds out there like myself is to the Arnold Tours v. Camp decision. The letter goes on to indicate that buying and selling crypto assets for custody customers as a riskless principal at a customer's direction is the economic equivalent to buying and selling crypto assets as agent for their customers, and is thus a logical outgrowth of a recognized banking activity, here the custody business. As to factor two, whether the activity strengthens the bank by benefiting its customers or business, certainly there's an argument that there's a benefit to the proposed bank's customers and business because of the offering of additional services in a growing market. On the third factor, focusing on whether the activity involves risks that are similar in nature to those already assumed by banks, as you might imagine, the key differences in a crypto asset transaction and a securities transaction are simply the underlying asset and the technology that's used. So the main risk in a riskless principal transaction from a traditional standpoint is counterparty credit risk. In particular, the OCC says settlement risk. And again, in what the OCC says, a perfectly matched customer-driven derivative transaction that settles by transitory title transfer, the main risk there, again, is credit risk. So in each of these activities, the banks, quote, neutralize its market risk through offsetting transactions, but retain credit risk due primarily to the ongoing financial obligations of the parties to the transaction, unquote. So the counterparty credit risk is identified in the traditional riskless principal transaction context, and also indicated to be, as a corollary, the same kind of risk that would be experienced by a bank in a riskless principal transaction that involves a crypto asset. So they say that the activity involves risks that are similar in nature to those already assumed by banks. They also identify operational risk because of the use of new technology. But again, they're already assumed by banks in other areas. So it's not a new or novel risk because of this activity. Finally, whether the activity is authorized for state chartered banks. The OCC indicates in their letter that state banks have a long history of engaging in riskless principal transactions with respect to securities, and the expectation is that the crypto asset type frameworks at the state level will continue to develop, but the fact that they don't have a specific authority to engage affirmatively in a riskless principal crypto asset transaction doesn't mean that it's impermissible. So none of the statutes or the state level statutes or state frameworks prohibit state banks from doing it. And so that, coupled with the development of the state regulatory frameworks, gives the OCC the comfort that it needs to say that because of this, the fourth factor, doesn't weigh against determining that national banks can engage in riskless principal crypto asset transactions. So again, we affirmatively see where the authority lies with the first three factors and how those apply. And with the fourth factor, the OCC essentially is saying, look, these frameworks don't prohibit it at the state level. And in fact, they're developing in ways to arguably permit it in the future if it's not already considered permissible activity. So finally, what's the conclusion? Under 12 USC 24/7, riskless principal crypto asset transactions, as they're described in the letter, are permissible for national banks. Okay, so what are some takeaways? What does this mean in practice, right? First, current leadership at the OCC clearly remains focused on permitting national banks to engage in a broader scope of crypto-related activities, and in fact has indicated in a number of other areas that they welcome applications to do just that and to engage in either de novo chartering for certain institutions or expansionary activities in this space. Second, as I mentioned, these are labeled riskless principal transactions, but they're not completely risk-free. Like I mentioned, the OCC indicated that there's still counterparty credit risk, just like there would be in a non-crypto transaction, and there's also potentially operational risk because of the technology. So these are not 100% without risk, but the concept is that the riskless principal transaction occurs in the way of an initial purchase by the bank that happens essentially simultaneously with a second transaction in which the ultimate purchaser of the asset purchases the asset from the bank, which ultimately means that there is not really any transaction risk to the bank by engaging in these kinds of activities. So I wanted to address this interpretive letter because it just came out, because it has some really good commentary around statutory authority and the business of banking, which is always a great topic, but also because it's just another in the line of interpretive letters that have come out from the OCC, both in the first Trump administration and this second Trump administration, around the ability of banks to conduct transactions and perform activities and provide services around crypto assets. What these letters essentially identify is that banks have long held authorities related to things like custody and safekeeping of assets, riskless principal transactions with assets and securities transactions and so forth. And so just because we have this kind of new asset class around crypto doesn't mean that banks all of a sudden don't have the ability to perform those same functions and offer those same products and services just because the asset class itself is different or is new. So not necessarily a clear expansion of bank authority, but rather using existing bank authorities to identify areas where banks can continue to serve customers in the crypto asset industry and ecosystem. So another piece of particularly helpful guidance for banks and other financial institutions serving or looking to serve the digital asset ecosystem. I certainly expect more to come in the way of supervisory guidance from any number of the federal banking agencies and state level banking agencies just in the new year in 2026. And in fact, the digital asset topic broadly will be discussed at length in more than one panel, probably every panel that we're going to have as part of the American Bar Association's Banking Law Committee standalone meeting in January in Washington, D.C. You can find information on that meeting, including the proposed agenda or the draft agenda, on the ABA's website. If you just do a search for ABA Banking Law Committee, January 15th to the 17th of 2026 are the dates. As you all know, I'm the chair of that committee, and so if you have any questions, feel free to reach out with respect to the Banking Law Committee or any of the questions that may have come up in the past few episodes of the podcast. So with that, I will conclude for this podcast and simply offer a happy holidays, Merry Christmas, Happy Hanukkah, and everything else to my dear friends out there. I'm going to call it a day. If you have any questions from any of our episodes, please reach out to me at jsylvia@dwaynemorris.com or your favorite Dwayne Morris lawyer. Finally, please be sure to like and subscribe wherever you get your podcasts. Thanks for listening in. And again, stay tuned for new episodes coming soon, brought to you by Dwayne Morris and the Money and Banking Law Podcast with Joe Sylvia. Thank you.